talked about this, right? Like, why the option premium, and we are not even going into the formulae over here. We are just like, the first of the derivatives you may have learned in your books. They started in Japan, where rice traders had this problem. How do I sell my rice and how do I hedge it? So they didn't have any sophisticated mathematics, and they were doing forward calls, right? So in fact, the futures market in Japan is one of the oldest in the world. So without going into mathematics, if Ali and Cherry were to, play this option game, then, and if they were, investment banks, Cherry owns an investment bank, Ali owns an investment bank, and if they were going to price options without going into the mathematics, they'll go by the basic thumb rules, and they'll say, oh, what is the value of the stock price? What is the value of the strike price? And according to that, they will, create a market. That's how actually a market is made. You think traders, who are there even selling and buying stocks, right? When you buy a stock, what happens? Computerized. If a human person is there, that person just takes a bet and creates a, spread. So if you are coming to buy TCS from me, I will say, I will sell TCS to you at a higher price, and I'll buy a TCS at a lower price. But you as a customer, your main job is to buy TCS at a buy low, sell high. Okay, are you with me?
Yes, sir. Following.
Yeah. Yeah. So now we also discuss this, right? This is quite simple. No, don't remember the formula at all. If you're a long call, the difference is just the spot price minus the exercise price. If you're a short call, it is just the negative of this, right? You take whatever you get on the long call, and you take a negative on this. And for put, it's the reverse. The put goes into money when the stock price goes below the exercise price. It's as simple as that, right? So now let's go to the next one. So we talked about the put call parity, right? The put call parity is nothing but, if you were to actually buy a call and buy a put at the same exercise price, and the same maturity. Are you guys with me? If you were to buy a call and sell a put, because this is a minus sign. Hello?
Yes, sir. Please. Yes,
Yes,
sir.
sir, audible.
We lost your voice just for a very small while.
Yeah. So if you were to buy a call and sell a put at the same exercise price with the same maturity, then the difference in the premium in between these two, the difference in between the premium in these two is nothing but the price ST of the underlying stock of both the call and put, because it's the same stock, right? Minus the strike price, and then you discount the strike price. This is just a discounting. All of you are familiar with discounting, right?
Yes, sir.
Yeah.
Strike price
So you're
at
just
present value.
exactly. So it's just a difference between the two. Okay, so that's a logical equation. Remember, it's called as put call parity. If you go to an interview, you should be able to answer this question without even knowing the formula. The formula is very intuitive. The formula is very intuitive. The difference in between the call and the put premium is nothing but the difference in between two prices, the spot price and the discounted exercise price. Okay, let's go to next one. Oh, we also covered this, the delta of the option. So the amount of option changes by and the amount by which the call option changes its value, uh, divided by the amount of change in the stock price. And we discussed why this cannot be more than one. There were two reasons for that, right? One is the probability itself, because this is a probability number. It's simply a probability that, what is the chance that this option will actually go into money. And it's the reverse way. The absolute value for puts, it's the mirror image. So you can just treat it as a probability number, right? No questions still here, right? I hope the class is clear, and we talked several examples. We looked at several examples of why this cannot be 1, and if Ali were to create a market, so for instance, this cannot be 2. Remember, the call is call on the underlying stock. If the underlying stock is running at a speed of 10 miles per hour or 10 kilometers per hour, the call, it cannot run more than, this is a bad example, sorry. The call actually can be sensitive, but it ranges between 0 and 1, 30%, 40%, 50%. It cannot be twice, right? If it becomes twice, then there'll be no market left. Everybody clear with this simple principle? We
Yes, sir.
can
Yes,
walk
sir.
through,
Yes, sir.
yeah, yeah, perfect, okay. So now we talked about, far in the money option and far out of the money option. If it is far in the money, the option behaves just like, what does it behave? The option behaves just like, so the imagine TCS strike price is 3,500 and the current stock price is 4,000. So the option will behave just like whom?
Sir, it will be irrational. So the increase will be very, very high, more than 500.
Sorry, what will be very, very high?
The
So
option
delta
premium
would
will
be
be more.
closer to 1.
Yeah.
Exactly. So the delta will be closer to 1. But I mean, just saying that the delta is closer to 1, understand the intuitive meaning. Because it is deep inside the money, if Ali were to make a market or if Cherry were to make a market for this stock, and if they were to sell this call to somebody, they need to sell the call in such a way that it has to run at least faster, as fast as the stock. If the stock changes by 100 rupees, the call option also has to change by 100 rupees, right?
Yes, sir.
Yeah. So that's, and if it is far out of the money, like, right now, let's say TCS price is 3,800, and the option, the price is 3,800, and the strike price is, let's say, 4,000, 5,000 rupees or 6,000 rupees. So it's far, far out of the money. No chance that TCS is going to, and then it'll closer to 1. The option price just doesn't change. It doesn't matter. And the put option, so can somebody give me an answer here? If it is far in the money, what will be the put option delta?
So would it be -1?
That's correct. Who's this?
So cherry.
Yeah. And far out of the money, it will be,
So 0.
yeah, that's right. Yeah. So so this is actually how it looks like. I'll give you the code for this. I'll send a code for this. And I've been asked to write give you an exam also. So can you tell me what kind of exams you would like to have? You want to be tested on the options fundamentals, or you want to be tested on coding, or you want to be tested on both?
Coding, I feel, won't make much sense in my opinion, because at the end of the day, it's not the code, it's what the code is telling us, right? So if you could have
Yeah,
something
correct.
about the interpretation or something, I feel that would
Correct.
be more relevant.
Yeah, correct. But I think your job as a master's in computational finance is not to be a coder, but at the same time you need to have the ability to interpret code. Okay, so maybe what I'll do is I'll give you a buggy code. It has got bugs in it, and you need to fix it. Perhaps is that a deal?
Works for me, sir.
Okay, and don't try to copy each
So
other
that
because,
would be a exam.
sorry.
That would be a tricky part in the exam because since we are still learning the code, it will be very difficult for us to understand the mistakes and
Okay, so why don't you do one thing? Like, I'll give you the code. You try to learn from each other. Each other, do, like in the US they have got open book tests, right? But try to solve it yourself, because that's the only way for you to learn. There's no other way, Cherry. So unless you push yourself, you're not going to learn. So try that. Okay, try that. I will think over it whether it should be marked or whether it should just be a fun exercise. But the moment we give it as a fun exercise, you'll not do it, because I've been a student too, right? But I understand. I hear your point. We'll try to, weigh it, give appropriate weighing, some weightage for the coding part, which will be lesser. I guess, Cherry, you don't have a engineering or any other background, right? What is your background, Cherry?
The economics only.
Yeah. Okay. So we'll but and the debugging will not be that hard. That I promise. Okay, so
Okay, so
anyways, yeah. So this is all generated in Python. Okay, this is all generated in Python. It is, you'll find the beauty of Python, how, it can just create numbers, it can create, price charts and so on. So now this is what I meant by a volatility surface. Okay. So we talked about implied walls, right? We talked about implied walls. So this axis over here is the implied volatility. And how did I already gave you an exercise. I already gave you an exercise that, given the realized volatility, given the option price, you calculate the implied volatility. So this is also generated in Python, by the way. It's a three-dimensional graph, right? So you got the strike rates on one axis, and you've got the time to maturity on another axis, and you got the implied volatility. So you can see over here, as the time to maturity increases, let's say as the strike price generally increases, it is going up. So you got to keep one thing constant always, right? Because you can't keep everything different. But what I'm saying here is that, traders actually generate these surfaces. This surface is nothing. So any point on this surface is just a number, right? So it's just a number. And what the program did was, the program went to Yahoo. It got the actual prices of Apple, the stock. Okay. It got actual prices of Apple. It calculated the volatility. It used some, it did some strike prices, did some time to maturity, and then it also got the option prices for Apple. So now I've got everything right in the equation. There's only one unknown, which is the implied volatility. All of you with me?
Yes, sir.
Hello? Yeah. And then once I get these values for each of the points, I get the implied, I get the, you got the stock price, the strike price, all the other things, time to maturity and so on. And you got the screen price. What is the volatility? What is the volatility? So I have a big matrix or an Excel sheet in which I get these numbers and I get the implied volatility. So for each time to maturity and for each strike, I get a small point, and then I, using Python, I create this volatility surface. Got it? So what option traders do is that, they will generally see this surface and they'll try to find out contours that are sweet. Okay, so this part is you could actually, the trader could go long. What happens in real life is that, traders don't care whether it's a call or a put. If you buy option, what happens? Tell me what happens if you buy option.
You get a
We
right.
saw that. Sorry.
I'm
Correct.
sorry. You asked what happens when we buy an option, right?
Correct.
We basically get a right to do something, but we do not have the obligation to do it. So it gives us options.
Right. No, the other thing that you saw is that, the option value increases as volatility increases, right? Even if it is a call option, even if it is a put option. We saw that, right?
Yes, sir.
So could we then say that instead of buying a call or a put, we are actually buying volatility?
Yes, sir. In a way, we are, because, like you said, it doesn't matter if it's a call or a put. What we want is for the price to actually keep on moving.
Exactly. So you're buying option traders buy volatility. So they buy volatility low and they sell it high. So if the volatility is at this peak here, right, what they will do is they'll sell the option. It doesn't matter whether it's call or put. So now there are two roles over here. In the option market, there are two roles, right? On one side is the buyer, and on the other side is the seller. Okay. So seller are mostly investment banks, and buyers are, institutional investors or retail buyers and so on. And why do you buy put option? Tell me, why would you buy put option at all? Suppose you have a large holding of TCS. Why would you buy a put option?
Sir, it could be because you're anticipating a downturn in the economy or a downturn in the business or something like
Exactly.
that.
Yeah, exactly. So you buy the put option, and who will you buy it from? Now, there could be sellers in India. Actually, lot of retail people, right? Retail people, what they do is they have this thing called it's a very dangerous game. You know what happens in selling a put, right? If you're selling a naked put, what happens is that you're basically you could lose your shirt. So if you are, or even a call, right? So what is the payoff of the call? The payoff of the call is this way, right? What is the mirror payoff of the seller? Can somebody tell me? Is the loss unlimited if the price keeps on increasing?
The loss is unlimited, but your upside
Yeah,
is limited, sir.
yeah. So this is what happens, right? This is what happens. The value of death. So people in India enjoy this. They get gratification that I'm selling the option. अरे कुछ नहीं होने वाला है. And that's it, that's the end of story. So important to remember, generally in developed markets there's a buyer and a seller, and generally the sellers are investment banks, large investment banks. India, of course, a large part of the market share of this, not large part, but at least 20% part is taken by retailers who try to sell and say, they punt that I'm getting this premium, let me earn it. But anyway, I raked it up because what we are saying is, in the option market, professional investors, and you will become a professional investor. You've got a MS in computer finance, a computational finance. So a professional investor will actually only look at volatility. They'll buy. So there could be complex structures, right? So you've got butterfly spreads, you got vertical spreads, and so on. But basic thing is a call and a put. So you can make combinations of these at different strike prices, a calendar spread, and so on. We don't want to go into that. You can devise your own spread and sell it to somebody. But at the end of this, always in finance, right? Look at what are the cash flows. Always look at what are the cash flows. People will call it anything. They'll call it futures. They'll call it a calendar spread. At the end of the day, it's a timeline, and at each timeline there is money coming in, and there is money going out, and there is a probability value P at each point in time. So our options price is actually calculated basis this. Correct? It's actually calculated basis this. Anyway, so let's go to the next slide now. So delta hedging. So delta hedging. So what happens is, suppose you sold, Ali and Cherry, they have sold a call and put option to, let's say, Neil and Shubham, and they have sold a call option and a put option. But now what are they? They are short or long volatility. Are they short volatility or are they long volatility? Ali and Cherry, they have sold a call and put option respectively. Are they short volatility or long volatility? Anyone?
Sir, I'm not sure what you mean by short on the volatility.
So we saw that what
Sir,
happened. Yeah, gone. Sorry.
sir, a seller of short will be short option will be like short volatility.
Sorry, I didn't.
Caller call
I missed.
option.
Sorry. Please come again.
Hello.
Hello.
Yes, sir. Am I audible now?
No, it's the voice is getting cut. Yeah. Hello.
Sir, he's rechecking his connection.
Yeah. Why doesn't somebody else answer? Ali and Cherry, they have sold options. So are they short volatility or long volatility?
So there'll be short volatility, right?
Correct. That's right. Because they are sold. So you have to get used to this terminology, and professional investors use that terminology. Are you short or are you long? Long is buying, short is selling. So now what happens is they are short volatility, right? And let's go to what is happening in practice. So you know uh, suppose now Cherry has sold it to Neil, and Neil is sold a call option to Neil, and Neil now is long 100 TCS call options, and the delta is 0.5. So what Neil will do is to become risk neutral, right? So 100 TCS call options are there. So how many should Neil buy from risk neutral? Neil has bought 100 TCS call options. And what is the meaning of delta? It is D by DC by DS,
Yes.
right? So for becoming risk neutral, now what has happened is Neil has bought these 100 TCS call options.
So
So he has
delta should be zero to be next delta neutral to
no,
risk neutral.
correct. That's right. Yes. So not delta, but for risk neutral, right? So right now, Neil has got this thing, so he has to short delta times the TCS stock, right? Remember this
Yes.
equation, DCS by DCS DC by DS, right? So this is equal to 0.5. This is equal to 0.5. And now how many will he buy? 0.5 into DS. And what is DS? It is 100. So now he sorry, short. So he's now short how many stocks? He's short 50 stocks. Now if he short 50 stocks, let's see what happens. He's short 50 stocks and long 100 TCS call options. Let's see what happens. So this is what he does. Neil does at t is equal to 0. Now at t plus 1, the price is down by 100 rupees. TCS price is down by 100 rupees. So what will happen to this short position? The stock position will be up by 50 rupees. Correct?
Yes, sir,
So could
correct.
you explain this T at T1 again?
So the sorry, just assume like not 100, just assume one TCS call option. And I mean, now assume that you could buy half a TCS share. You could buy half, make it easier. So if you buy half a TCS share and the price of TCS is down by 100 rupees, one TCS share, the price is down by 100 rupees. But since you're short the TCS stock, right? Remember, you're selling the TCS stock. The TCS stock the short position will be up by how much? 50
50.
rupees.
Yeah, okay.
Correct?
Thank you, sir.
Yeah. So that's all it is. So now the option price is down by 50 rupees. Correct? Because your call option, and the call option payoff is this way, right? The call option payoff is this way. The price was, this is a strike price. This is actually reduced. So you're still out of money, and the delta will react. The delta, because the delta is 0.5, the call option value will be down by approximately 50 rupees. So given this, your net P&L will be zero. Everybody with me?
Yes, sir.
Yes, sir.
Now do the reverse thing. The price is up by 100 rupees. It's exactly reverse, right? No, I mean, no rocket science here. If the price is up by 100 rupees, option price will be up by 50 rupees. And because the delta is 0.5, and the stock position will be down by 50 rupees. So net P&L will be zero. Everybody okay here?
Sir, I'm a little confused with
Yeah. So
this
on
idea.
day one, sorry, who's this?
Neil, sir.
Yeah. So on day one, what happened, Neil? You bought the call option.
Yes, sir.
you got a call option from Cherry, so you bought one call option, right? Now
Yes,
the
sir.
price of the call option, uh, what happens? So this was on day one, sorry, day zero. On day one, what happened is TCS price went down by 100. See, call options react to what happens with the TCS price. So on day zero, you bought this one option and you were short the TCS stock. Forget about 50, right? I mean, we are just saying zero point 0.5 stocks. So you were short 0.5 stocks and you bought one option.
Okay, sir.
Okay. So now what happens is on day one, TCS price is up by 100 rupees. TCS is up by 100 rupees. So let's say TCS price was 3,500, it became 3,600.
Okay, sir.
Sorry, 3,400, not 3,600, 3,400. It became 3,400. Now, since the price went down, what will happen to the call option?
It becomes out of the money possibly.
Yeah. So that's why it will lose the price for this one, the option price, because the delta is zero point 0.5. Remember, it is DC by DS, right?
Yes.
So DC by DS is equal to 0.5. And if I substitute values, the price went down by how much? 100 rupees. So I say DC is equal to 0.5 into 100, which is equal to 50. Correct? And this is the
Yes, sir.
value you get. You agree with me?
Yes, sir.
Yeah. Now, what is simpler to understand is that since you are short the TCS stock, half the stock position is actually gone up because it was a short position. This was a short position.
All
Correct?
right, sir.
Yeah. Now, exactly reverse happens on day two.
And has it gone down by 50 rupees because we've only bought half a option? Only
Yeah,
only
correct.
sold half an option?
Correct. That's right.
Okay,
Yes.
sir.
Yeah. Okay. So right now at T plus 2, we are back to square one. We are back to square one. But what I'm showing you is the movement in your net position. And
So
this is delta
just
hedging. What you do is you go long, then you have to go short.
so just a doubt. This
Yes.
is absolutely theoretical, right? Because our delta can keep on changing over time, I assume.
Good question. We'll come to that. So right now, just for we are taking baby steps, right? So we have to. When I was also probably your age, when I was your age, I was a computer engineer. I didn't even understand. You got a better, you got a better shot now. So I was. So this is an intuitive example to just to taking a baby. Somebody was spoon feeding me, right? So to make it very clear in one's mind's eye that this is what happens. You go long on the call, you have to go short on the stock, and you're delta hedged. You're risk neutral.
Okay, sir. So this actually reminds us of this one model we had done little earlier,
Huh.
which I think is called some binom. So I forget the name.
A
Uh,
binomial pricing model.
yeah, but binomial pricing model. They do a
Yeah.
similar thing, and they try to estimate delta using this.
Yeah, correct. So you can use anything. So delta we estimated using Black-Scholes, right? So Black-Scholes is nothing but it is the ethos lemma. So the equation we saw that it was forget about all the complications. You can have hundreds of things to estimate the option price. It could be even a Monte Carlo. You could do a Monte Carlo to estimate the option price. Run thousands of simulations with some probability and you estimate the price. We'll come to Monte Carlo later. But right now we are just concerned about the net position that Neil has got. And that net position, it became long because Neil bought the call option. So to hedge that, Neil went short the TCS stock. Everybody clear on this?
Yes, sir.
Yes, sir.
Yes.
Okay, so now let's go to the next piece. Now, I think Neil or somebody mentioned, what happens. So the gamma of the option, is a change in delta. This is a sign for gamma. So it's a change in delta given changes in the stock price. So in fact, gamma of the option is nothing but d of delta divided by d of what?
Sir S.
Yeah, correct.
So,
So
sir, in
this is
that case,
yeah.
sorry, in that case, can we say that gamma basically works the way beta works for it works the way beta works for the stock. Gamma works for the for the underlying stock. Can we say
No, no.
that in
What
that
is
way?
beta for a stock? Can you tell me who is
No, no,
this? What
Ali,
is
Ali,
beta
sir.
for a stock? Ali. So
Sir,
what is beta? How do you define beta for a stock? Tell
sir,
me.
it's the sir. It defines the stock sensitivity to the market, right? So similarly, gamma defines the stock sensitivity of the derivative to the underlying strip.
No, but what is delta then? So if you're calling beta as the sensitivity, beta has got a what is the what is the mathematical definition of beta?
So I'm sorry, I don't know the exact mathematical interpretation of
Now,
it,
I'll tell
but in
you.
simple,
So
yeah.
you need to, I mean, as computational finance folks, you need to really, in Marathi we call like, you have to, I mean, I'll not use the Marathi thing, but sir, because I don't know if there is any Marathis here. But what you have to do is really, really, take the pot, stir it again and again and again and again. Be very comfortable with these things, especially the beta. So the covariance in between the stock and the market divided by the standard deviation of the stock or the market. Okay, so you have to be very comfortable. So what is covariance? Covariance is, how do you calculate covariance? You take the mean return of the stock, sorry, you take the return of the stock. So you got a, imagine you got an Excel sheet, and in that Excel sheet you got these returns, right? So the return you take, each return you take, and you take the difference between the mean return, get that array. Similarly, do that for the market, and that's the covariance. And then you scale that by the standard deviation. Okay, so that is what beta is. Now, the interpretation of beta, another interpretation of beta, somebody told me yesterday or day before yesterday, like, what is that formula? The CAPM model?
RF plus beta, RF
Yes,
minus RM.
correct. So you can derive beta from there also. So it is quite different. Beta is little bit different, Ali. This is, let's go to the basics. This is d of delta. I mean, don't be afraid of the derivatives. It's just a term. Just assume that what is delta. Delta is a small change in the price of the call option divided by a small change in the price of the stock.
So
And what?
can we say it's the double derivative of C
Correct.
given S?
Correct. 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 Yes. Yes. But don't go into that, because you'll think about Cherry and Ali as market makers. How will they? What will actually happen to the stock? What will happen to the call option? All I'm saying is that because this is already a derivative, right? This is already a derivative. This is going to run at a there is something called as a second derivative, which is going to run much faster. All it is measuring is the change in delta, because as somebody, I mean, it was intuitive for you. You didn't know the maths, right? I think Neil asked the question. The delta will change. It is intuitive, right? I mean, if Ali and Cherry are making a market and they're selling these stocks, they are they must be scared. Especially, I think Cherry sold a call, right? She sold a call. Now, if she sold a call, she's exposed to the short position. What if the stock just rises up? And this is where she's concerned that how is the delta going to change if the stock price is changing. And then people looked at hundreds and thousands of markets, and they said, oh, this is called as gamma, and we need to be concerned about gamma. And what is gamma? So you can actually work it out. That's why, like, if you take the Excel sheet, if you write the prices, right, if you find the delta, you find the gamma, you will see that these become, like, we don't have the time or the space to actually work through example, but you have to do it yourself. No textbook will actually give you lots of maths explanation. I have just taken the gist. Just believe in this. And what is the gist? If gamma is small, changes in stock price do not affect the delta. I mean, there's no rocket science here, right? Let me write the definitions here again. What is delta? Delta is nothing but the change in price, the call price, divided by the change in the
Change in
stock price.
underlying asset.
And what is gamma? Gamma is nothing but the change in the delta
Delta.
divided by change in the stock price. So if gamma is small, changes in stock price do not affect delta much. That's very true, right? So suppose, oh sorry, I should not have done this. D of C divided by D of S. Problem is, on this computer I can't use a pen to write it. If anybody has a better suggestion next time, we could use that. So D of delta upon D of S, right? So imagine that this is like 0.001. All it is saying is that no matter how much this changes, because this is low, the changes do not affect the delta. Delta won't change much. Okay, got it? But on the other hand, large gamma can be very problematic. Can you tell me why? Imagine Cherry has sold a call option to Neil.
Sir, is it because if the value of gamma would be high, then to get delta as zero would be much more difficult to get that
Yes,
risk neutral?
yes. So now you sold a call, right? You sold a call, correct? Cherry, to Neil. You
Yes, sir.
sold the call. So you're short. What will you do? You'll For delta hedging, you'll have to buy the stock, correct? You agree with that, right? Neil, on the other hand, he was long the stock, long the call, so he had to sell the stock for him to become delta neutral. Is that fine?
Right, sir.
Yeah.
Sir, I'm
So
sorry, I'm
now,
still confused. What's the
yeah.
intuitive understanding or the meaning of gamma in general? Like I
So
understood
I'm
the
coming to
formula in
that.
general.
So I'm coming to the intuitive understanding. So Cherry has sold a call option, correct? She sold a call option, and after selling the call option, what has happened is she's landed with a short position. Now, to compensate, to make herself delta neutral, what Cherry has done is she's bought the stock. Correct? Now, since she has bought the stock, what happens is that now if the gamma is very high, let's say if the gamma is 100, just a number. So what is happening is that the gamma is very high, the delta is changing very fast. It is changing magnified by how much? 100 times. If the stock price changes by, let's say, 100 rupees, what happens is this 100 into 100 get multiplied, right? And then this becomes how much? 10,000, correct? So as the stock starts climbing, right, Cherry short the call option, and to make herself delta neutral, she has to keep on buying lot of stock in the market. Just keep on buying stock because the gamma is very high. Now that is going to, she is going to spend money for doing this, right? Just to make herself delta neutral, she's going to, sorry, I don't know what happened. So just to make herself delta neutral, she has to go to the market and keep on buying stock. That's the intuition. It gets 10,000 times magnified, 100 gamma. If it's 1,000 gamma, it gets even more magnified. So that's the problem. Okay, that's why large gammas are problematic. Now here I'm just saying, Cherry is short the stock, short the call option, and she has to buy the stock. She's at least happy that she has got the inventory, like she's got the short stock inventory with her. Reverse the position. Ali has actually what Ali did was he shorted the he was long the call, right? He was long the call. Somebody sold the call to him. Now he has to actually short the stock, right? He has to short, or Neil has to short the stock. For a large gamma position, it affects both the buyer and the seller. For Neil to be delta neutral, what does Neil have to do? The stocks keeps on climbing. It keeps on climbing higher and higher and higher and higher. To make himself delta neutral, Neil has to go and short futures. And the reverse thing is happening with Cherry. She has to keep on buying the stock futures or the actual stock. So large gamma makes things difficult. And there are certain areas where gamma becomes really large. That is what option traders are scared about. I'll come to that. The other thing is, this rule of thumb is that their calls and puts, they are identical. Everybody okay with this so far?
Yes, sir.
Yeah. So let's go to the next one very quickly. So this is what happens to the gamma versus the stock price. So I mean, I should not have done like, gamma call, gamma put. So call and put, they're exactly the same. So that's why you're seeing three curves. So this red curve got blurred by this blue curve, right? They're exactly the same. But you can see that, the strike price at the K is equal to 15, which is strike price, at this value, the gamma just shot up, right? The gamma just shot up. Let's go to the next one thing. And this is what happens when it goes to maturity. So when gamma is at when the stock price is 40, let's say, and there is an underlying strike price also. When the stock price is at the money or in the money, right? This gamma can become infinite. This is what option traders are really scared about. So you don't want to be in a position where you are short gamma. You are short gamma. What is short gamma? Meaning, you have to, as the stock keeps on climbing, you have to short more and more stocks. So that if gamma becomes, even if you are long gamma, it becomes a unmanageable position to delta hedge. Do you get me?
So mildly not so.
Yeah. So this is what actually really happens without going into the maths, right? At the money, I mean, how did I plot these curves? I plotted these curves using Black-Scholes model, okay? And actually getting the values of gamma and the delta. I plotted these curves. So what is the value of K? What is the value? I made up the values of K and S, the strike price and stock price. As you keep on, I mean, we are just taking observation, like, measuring the thermometer, using the thermometer, measuring the body temperature. That's how I'm just calibrating my model, and many people have done this. And what you'll see is that the gamma just shoots up. The gamma just shoots up as you go closer to the maturity, and if your stock is at the money or in the money, is what I'm saying.
Sir,
Yeah.
here it's actually showing the other way around. So time to maturity value it increases.
Sir, time to maturity decreases as you're towards the maturity. So I did T minus T. Okay, that's why you are seeing it here.
Okay,
In the
sir.
graph, you will see it this way. This is not a wrong graph. This is not a wrong graph. I don't know who asked this question. Good to point out. Who was this?
Neil, sir.
Yeah. So in most textbooks, you will see this because they show time this way. I'm showing time this way. It's the same thing, right? As you go closer to the maturity, and if your thing is just interpret it this way, closer to the maturity, not time to maturity. This is wrong. Closer to the maturity. As you go closer to the maturity, the legend is wrong. The data is correct. I mean, it's all made up random data. Textbooks will give you this, and I got too bored to copy the textbook. The point really is that people were doing all these observations and at the money uh, stock prices,
Sir,
at the money options. Sorry, yeah, go on.
just a doubt. I'm still not clear. As we are closer to maturity, is the gamma higher, or as we are far away from maturity, the gamma is higher?
Closer to maturity.
As you're closer to maturity, gamma is higher. Okay, thank you, sir.
No, when it is higher, there's one more condition there.
So what about when the option is out of the money and in of the
Yeah, so
money?
this
Then
is
the
what
gamma
happens.
would be zero.
No problem. See, this is where you are, out of the money. So 50 is at the money, 52 is is in the money, and 48 is out of the money. This is for a call option, if I recollect right. But it's the same thing for a put.
Sir, I have two questions on this.
Yeah.
So one, how, like, why is gamma changing as we are nearing the maturity? Because gamma is eventually dependent on the underlying delta, right? So delta, and
Yeah,
again
correct.
delta implies the volatility. So volatility is irrelevant to the amount of time that is left, right?
No. So what happens? I mean, that's the other. So we are doing Greeks. What happens
Okay.
is, uh, when you go closer and closer to the maturity, you know, think about it. Like you are, who's this? Sorry.
Ali, sir.
Yeah. So Ali, you have sold the option, right? So the
Yeah, correct.
uncertainty increases quite a bit. What will happen? What will happen? So think, I mean, forget about the maths. Forget about the maths. You've sold the option. As you go closer and closer and closer to the maturity, and your option is at the money or near at the money. Now, there's a good chance actually it can hit the jackpot and you will be out of business. So that is what is happening. That is the intuition with this.
But sir, again, prices are gonna converge eventually, right? So now that I think of it, delta is gonna reduce. Gamma should also get come down, right?
No, gamma is the derivative, no? So what is so d of what is gamma? D of delta by
D of
dx.
S. Correct.
Yeah.
Yeah.
So that is what gamma is. Now, if this becomes infinitesimally small, whereas this doesn't change as much,
Mm-hmm.
right? Gamma shoots up, is what it means. And typically, what they're saying is that the behavior, there's a maths involved, there's a background to this, right? Typically, as you go closer and closer to the maturity, because delta itself also is, if you recollect, it depends on time to maturity. Correct?
Yes, sir. True that.
Yeah. So delta actually increases. The probability that your option is going to go in the money increases as you go closer and closer to the maturity. Intuitive there?
Okay, cool. Okay, now so
Yeah.
one more question. Then I'm clear
No,
on this
no,
part.
no, one second, one second. That's intuitive there.
Yeah,
Now,
correct, sir.
the problem is that as you go closer to the maturity, and you add one more condition that you're very near, you're at the money.
Okay.
Now that creates a lethal combination, is what I'm saying.
Okay, got it. So because now it's gonna go either ways, and wherever
Yeah.
it goes, it's just gonna shoot
Yeah.
whichever direction. Okay, I
Yeah.
got this part. Now it's just again, like you said, this is what, this is a bad thing if I'm selling an option, be it a put or a call, be it a put or a call, right?
Yeah. So what happens is, yeah, tell me why it is a bad thing when you are selling. No,
Because again, when I'm
forget about selling an option or buying an option. When you are a short stock,
yeah,
why
exactly.
is
So
it
if
bad?
I'm short, it's
Yeah,
bad because my upside is limited, my downside is unlimited, right?
correct. No, I'll tell you one more intuition actually. What happens is in a dying market, I don't know how many of you have actually seen the 2008 crisis, actually felt the crisis. I mean, I was fortunately at the desk on that time, but it was almost a earthquake every single day. So the stock prices just kept on going down, and even in COVID, right, last year, if you saw, the stock markets took a steep fall. Do you recollect that?
Yes, sir.
So what happens is if you're a short stock, now this is one more principle, right? As the market goes down, volatility actually increases. But volatility does not increase as much as you go up. Volatility is an indication of fear and anxiety. Think about it that way. And as the market goes down, volatility shoots up. Okay, are you with me?
Yes, sir, yes.
Yeah. So that's what it is. Let's move on quickly because I think I don't know what time it is now. I've still got 45 minutes. So now, we've got the theta as well. So we talked about delta, we talked about gamma, and then this is theta. So this is nothing but a derivative of option price. The derivative of the option price, sorry, d of the option price with respect to time. So what happens is, actually, if you just take everything else being constant, the what intuition will tell you that the call option will just decrease in value as you approach maturity, right? Everything else being constant. You should think about it that way. Why is that the case? Everything else being constant, Ali, you've kind of let's say Neil has bought the call option. He will feel it the most. Why should theta be negative?
So, may I try?
Yeah.
So, as you mentioned, when you buy a call option, you're basically buying volatility. Correct.
Yes.
So now, if we go ahead with that assessment, the more time you have, the more time you have to harness your volatility. So, as the time keeps on going ahead, you are losing what really makes your option special. So hence your DC by DT is negative.
Correct. Right. So but not. Sorry, who was this?
Neil.
Yeah.
So with Neil's answer, can I continue?
Yes.
So with the it's kind of the same thing, but as the time increases, time to maturity decreases, and the option then delta C by delta time to maturity would be greater than 0, hence theta would be negative.
Mm, I suppose it was Cherry. No, I didn't understand your answer.
So I'm saying as the time increases, as the time passes by, the time to maturity decreases.
Okay.
And then delta CT by delta time to maturity will be greater than 0. I could be totally wrong here. And that's why theta is negative.
Yeah. So delta C by delta T. I mean, uh, it is negative. I mean, I didn't understand your positive comment. I mean, what Neil was saying is, look at it this way, Cherry. Like you've got the option. The chance that the option is going to be in the money, it becomes lesser and lesser and lesser and lesser as you go closer, as you go very near the maturity, right? The chance, the probability. Remember, delta is the probability that the option is in the money, isn't it?
Yes, sir.
Yeah. So that if that chance becomes lesser and lesser and lesser as you go towards maturity, what should happen? So what? Suppose my delta was 0.6, and it is my option is expiring in 6 months' time, and now 3 months have passed. Should delta increase or decrease? Everything else being constant.
So delta should decrease.
Correct. And that's what theta is. So that decrease, it should decrease because my probability has gone down, right? So the
Yes, sir.
relative change, yeah. So you got it now? Shall I move on?
Yes, sir.
Yeah. So the theta, you can see this here again. The theta will, it's negative, and then at the strike price again, at the strike price it shoots up. That's what the quirk is. I mean, there's a mathematical reason for that, but remember that at the strike, it suddenly becomes very very big. Okay, so let me go to the next one. So now we go to Vega. Vega is the derivative of option price with respect to volatility. So now here we are doing something entirely different. We are saying D of C divided by D of volatility. So the change in the call option price relative to the, let's call volatility as fear, so that you will never forget it. If the fear increases, what will happen to the stock price, the call price? And if the fear
So
decreases, what will happen to the
I
uh,
don't know about
Sir,
fear. Yes, Ali, after you.
no, Neil, go ahead. It's okay.
So I don't know about fear, but I would assume that as your volatility goes up, it should usually be positive, because you want to buy something which gives you more spread as a person who's buying an option.
yeah, do you agree with what Neil is saying? Anybody who disagrees?
Sir, I think if the fear increases, be it
Yes.
towards either sides, option premiums would also increase. Isn't that true,
Yes,
sir?
that's yeah. So that's what it is, right? As uncertainty increases, I mean, there's two names to it. One is fear, one the other is uncertainty. As fear and uncertainty increase, we are going to get a problem. Problem meaning, the call option premium will increase. Now, the interesting thing is, as we saw about gamma, even Vega is very large when stock price is trading close to the strike price. Okay.
So if Vega is large, then the option value would be very sensitive to changes in volatility, the fear.
Correct. 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 And intuitive again, right? When it is actually especially closer to the strike price, it becomes like really sensitive. Okay. Are you okay with this?
Yes, sir.
Yeah. Let's go to the next one. So this is what happens. And rule of thumb, like whenever you're near the strike price, this is what happens. This is Vega, right? Vega here, and you got the underlying stock underlying price. Okay. Let's go to the next one. So now delta hedging. Okay, so this is something that you should remember. 70, 80, 90% of the time, delta hedging will actually give option traders a profit. You can work it out. So this is an Excel sheet. And in the Excel sheet, I can't do this in slide mode. But let's say you got a delta of 0.4, you got a gamma of 0.02, a theta of minus 0.1, stock price is 100 rupees, strike price is 120 rupees. You're long one call for rupees 40. Okay. So now since you're long one call for rupees 40, it will be short 0.4 stocks for rupees 100 each, right? To make it delta neutral. So check the cash flow. So on day 0, 100 is the price, and there's nothing. The P&L is nothing. On day 1, assume that this price goes to 90. Then you have to buy the stocks. So this is what you get, and the net cash flow is this, because there's a value for the option also. You go to day 2, day 3, day 4, and you get the net P&L across time as 4, and minus 4, which is 0. So what happens in the theta loss, right? So theta across 4 days, 1, 2, 3, 4 days, the theta is 0.01. So 4 into 0.01, so you are going to lose how much? Minus 0.04. But it's 100 rupees, so you are going to lose a net of minus 4. Now, because of this delta hedging business, you are gaining 4. So your net loss is actually 0. That's what it is. You can work it out. I'll send a spreadsheet to you. But this is like really, really simple. I did nothing. I just came up with, imaginary prices 90, 80, 90, 100. Just the price is changing like day to day basis. Went down by 10, uh, went down by 10 again, came up by 10, came up by 10 again. End of the day, for this price combination, this is the net P&L. Okay. Are you all okay with this? Can I move on? Hello? Can I move
Yes.
on?
Yes, sir.
So now, what happens is the thing is that, on average, like people do it, right? So there is maths involved in this, and for that you may want to read Taleb's free book on the internet. And you should also beware that long-term capital management. Do you know LTCM?
No, sir.
Okay. So long-term capital management went bankrupt in the late 90s. It was found by one of the Nobel laureates and one of the inventors of the Black-Scholes model. Okay. So although the model is called Black-Scholes, there's so Merton. Okay. Robert Merton was a co-founder of this long-term capital management. Now, maths works 99% of the time. But there is a tail risk. What is a tail risk? You know what is a tail risk, right? So tail risk is this. This is tail risk. An event that can happen 3, 4, 5 standard deviations away. So this is 1 SD, this is 2 SD, this is 3 SD. So for example, earthquakes, they are very rare. They can happen maybe once in, you know, not one lifetime, once in, 1,000 lifetimes. Dinosaurs hitting the earth, it could be a 15 standard deviation event. So similarly, although this delta hedging almost always works, and option traders, there's a trick to that, and that's why people make money. You must be, you must be intrigued. Why will people make money in delta hedging? Because there's maths involved, and don't worry about it. You can try it. I mean, there are people, option traders are like rugby players who are school dropouts. Believe in the principles that I just shared to you, or in the last 2 3 days, and they work on those principles. So, uh, so the thing is that upward stock. So suppose so your long calls, right? So you benefit from price increases, and if Y is the upward stock movement, new delta is delta plus gamma Y. No, no doubt over here, right? No questions here, right? Delta plus gamma Y. Why gamma Y? Because that's delta itself, and the stock has moved by Y. So that's a new delta, right? Correct?
Yes,
You're
sir.
with me?
Yes, sir. Delta is the previous one, and gamma is the change, and
Yes.
how much it has changed by. So yes.
Yes. So the average delta or upward stock movement is nothing but you started with this delta, and then you ended up with this delta, and you divide by 2. No rocket science here. Correct? Is there any rocket
Yes, sir.
science?
No,
All
sir.
simple, right?
Initial and final divided by 2.
Yeah, exactly. And then the increase in option price is nothing but this, right? The average increase. Now you need to sell these stocks for delta hedging, right? Gamma Y stocks have to be sold, and the loss incurred on that is minus delta Y. So the total profit in a dynamic hedge is this on average: gamma by 2 plus Y square. Now in market conditions, see, averages are always funny, because averages have got, it's a spectrum, right? It's a spectrum. So this is the average. You could be here, you could be here. But on average, the total profit will be this. Now, the good thing about delta hedging is that almost 70, 80, 90% times, I mean, people say 99% also, you'll be always in the money. You'll make money. And how do they typically make money? They typically, you need to be intuitive about what you are hedging, delta hedging. So people are experts. They spend, good amount of time understanding an underlying stock or an index. So what are the variables here in delta hedging? You could hedge on a daily basis. You could hedge if the tick size is, let's say, 100 rupees or 1000 rupees. Completely up to you. But over period of time, you know when to delta hedge. And the moment to delta hedge at the right time, you actually generate money for yourself. Okay? Is this okay? Any questions?
So no questions yet. Just need some time to digest all of this, you know.
Yeah, so yeah, correct. Yeah, you can. I mean, see, till this point in time, you all agreed that actually there is no rocket science here, right? I mean, this is all calculated. It's simple algebra. We calculated this in front of you. You start with this happens, then this happens, and then this happens, and the total profit is this much. Okay?
Yes, I guess we can move on. We'll need
Yeah.
to look at this once again, you know, with a fresh mind to again.
Yeah, yeah. So what I would suggest is that you can play around. You can play around. I mean, I don't know how much time you got. Uh, I mean, if you want to, options are a fascinating thing. You can actually, as I said, you can take an option and start to delta hedge, and then see what happens. First of all, you can do it on. First of all, you can do it on paper in an Excel sheet, and we are going to Monte Carlo soon. We are going to Monte Carlo soon. You can also simulate thousands of paths, okay, to get a feel of what will actually happen. Now, events and option trading. So basically, traders seek either a large gamma or a large vega, but not so large. You want a large gamma, but not so large as to kill you. This is not what you want. Asymptote infinite gamma. You don't want that. But you want the sweet spot is fairly large gamma, right? You want it here somewhere, maybe here somewhere. And both Vega and gamma provide traders to trade volatility. So especially traders become active on large gamma positions. Short expiries allow traders to delta hedge. On the other hand, for a large Vega, long expiries provide traders with expectation that volatility will pick up. Because I mean, just take it for as a rule of thumb. Vega comes into play if it is a long dated option, like 1 year option, 2 year option. You got ample time for everything to happen, right? Delta is small and subdued, gamma is small and subdued, but the long expiry will make sure that the volatility. So suppose you may say that something is going to happen to, let's say, TCS in 2 years time. You may be TCS is not a good example. You are looking at a chemical company, let's say, a chemical company, and because of ESG, and this chemical company is right now polluting the water. It is polluting the water, and you are seeing that, you think that the regulator is going to come with a big danda in their hand, and they are going to really smash the chemical company. And you think that this will happen in 2 years. I don't know, any of you have been to Bharuch, or what's that place called near on the Ahmedabad highway? It is so bad you can't even breathe. Have you been there? There's a place, I forgot the name of the exact place, but on the Bombay Ahmedabad highway.
Vapi, right?
Vapi. You been
Uh,
to Vapi? Who's this?
Sir Gaurav.
Yeah. So these chemical companies, cigarette companies for that matter, right? It's they have no future. Why is there no future? Because the government is coming with a stick. It's not politics, just government gets money. But still, what's bad for people, it's bad for government. And they're coming with regulation. So you expect a bad event to happen in, let's say, 4 years' time. You are astute. Let's say Cherry goes to Ali and she has this information. She goes to Ali and says, can you sell me a put option which is 4 years old? Now Ali is smart. He will also do his study on this particular stock, and he will sell it at a price that makes him comfortable. But anyways, these long expiries, allow a large vega, and what they will do is traders buy this with the expectation that volatility will pick up. Okay,
So there's
everybody
one
okay here?
question.
Yeah.
Sir, all this is one thing, but then how
Yes.
do you account for the impact of macroeconomic factors, external factors, not shocks as such, but what your fundamental analysis tells you?
Correct. That's a great question. In fact, my job as a you know on the trading desk was to actually marry fundamental research. Exactly as we said, right? This chemical company is going to the dogs. You as a
Exactly, sir.
fundamentalist.
Exactly. But then
Yeah.
all this, all the indicators are saying that it's a good stock in terms of technical analysis. But the fundamental, you are there because that's why, that's why we don't have machines doing this work for us, right?
No, so sorry. So much. I mean, I don't know what your question is. I think it's Ali, right? I don't know who it is.
Yes, yes, sir.
Yeah. So machines, there is nothing such as general intelligence. The topic of artificial intelligence is fascinating, but we are human beings are yet to come up with general intelligence.
Okay.
Okay, so that is why people like you will become stock analysts, and they will marry this to the. So basically, investing is about identifying mispricings, right? All investing, forget about derivatives.
Okay.
Anywhere you find a misprice, what will you do? Your basically job in life is to buy low, sell high. Correct?
Correct. Yes.
Be it volatility, be it uh, you know uh, anything, right? A call option or a stock or even a bond. If you see that good part of the market is being foolish, you become the smart guy. That's one way of making money. Now, if you don't want to actually do that active bet, what you can do is safely buy an index fund. But anyway, let's not go into that. What I'm saying is that as a market specialist, your job is to identify mispricings. Shall we move on?
Okay, sure, sir.
Yeah. So we now come to a very important concept called as skew. So what happens is markets price lower strike options expensively versus higher. Now, we talked just a few, maybe minutes back, or, tens of minutes back, we talked about this problem that, as the market starts going down, generally what happens is the fear factor rises and the volatility rises. In fact, options with lower strike prices, right? Lower strike prices, they have got higher implied walls. Okay. So they have higher implied walls compared to markets. So lower strike options are expensive versus higher. Just the quirk of the market, right? Just the quirk of the market. Now, what that means is there is a skew. If you got a call option, lower strike and higher strike, there is a mispricing in the volatility, and it is skewed. That is the meaning of skew. Okay. So the implied walls for lower strike prices are a little bit higher compared to the implied walls of a higher strike price. This is what the skew is. Sorry, this should be a horizontal line. The skew is nothing but if this is low, this is high. And if this is at this level, the wall is at this level, this wall will be at this level. I'm just making it up. So this is called a skew. And the reasons for this, so this is what you can go and look at any index, any TCS, or actually put those numbers on paper, and you can plot. You can see that, you can see this is what will happen. So as markets go down, and the reasons for the skewer, as markets go down, they're more volatile. As prices become lower and closer to strike, the gamma is higher, leading to higher vols. Low strike option delta needs more frequent hedging, right? Lower strike. So the seller charges higher. And we already discussed this. Will volatility be lower or higher in a falling market?
It will be higher, sir.
Correct. Let's move on, shall we? Everybody comfortable? So can I move on?
So this is Q of what exactly?
The skew in the volatility.
Skew in the okay,
Yeah,
okay.
so skew in the wall. So I'm saying a call option. Okay, a call option for a lower strike versus a higher strike will have a higher volatility compared to the implied walls, right? I'm talking about implied walls compared to a higher strike price for same maturity. So this is the skew, the mismatch.
So then just one question again on this.
Yeah.
When you say a higher strike price, should you not also consider the CMP, your
Yes, no,
current
I'm
market
saying
price?
all things equal, right? All things equal.
But then, sir, in that case, so in that case, when we say a lower strike price, do we mean something that is closer to the current market price, or that something that is low in, something
No,
that is
just go to
generally low?
Nifty. Okay,
Okay.
just go to the Nifty, the NSE website where they
Yeah, yeah.
display the option prices, right?
Okay.
So for those option prices, look at lower. Your maturity must be the same.
Yeah, correct.
Now jot down the prices for the options with lower strikes and higher
Hmm.
strikes. Now use the Black-Scholes formula to calculate the implied walls. And when we calculate that, you'll find this. You'll find this Q, is what I'm saying.
It's, yes, sir. So the lower ones are priced at around 1,500 rupees or so, whereas the
So,
ones that are closer to the current market price at around 145. I'm talking about premiums here, sir.
no, no. So take those call premiums and
Okay.
find out the implied wall using Black-Scholes formula.
Okay, okay. Oh, okay, okay. Got it, sir.
Okay.
Yeah, yeah.
Got it?
Yes, yes, sir. Got it.
So that is no matter. And if you find it reverse, what will you do? Who was this? Who
Ali,
asked the
sir.
question?
Ali, sir.
If you find that there's a mismatch, what will you do?
Sir, it's an arbitrage opportunity.
Exactly. Okay. Shall I move
Okay,
on?
sir. Got it. Yes, yes, sir.
So we talked about, I briefly introduced to you Monte Carlo. Okay. And Monte Carlo was this was actually during World War II. Okay, that's a brief history. And Monte Carlo is, it's a casino, right? So people said that, let's say you can do an experiment actually. It's a simple experiment. Draw a circle, okay, of a I mean, it's not a simple experiment, it's a complicated experiment, because if you have a circle, imagine you have a circle of radius r and a square of side r, right? So area of the square is r square and area of the circle is pi r square. Simple. Now suppose it were to rain, okay, by chance, or rain. Suppose it were a hailstorm, right? And those frozen nuggets of water come down, and you're a day long hailstorm, and it is following equally with equal chances on the square as well as on the circle. So what Monte Carlo says is that the ratio between these two, it will become pi, exactly pi. Okay. You're with me, or have I lost you?
So could you please repeat this once again?
Suppose there is a hailstorm, and what happens in a hailstorm? You got this frozen pieces of
Ole.
water that they come down.
Yes, sir. They call Ole.
Sorry.
Ole.
Okay, so this is in which language?
Sir, I think isn't that Hindi?
Okay,
I thought. I assumed so.
in Marathi it's something else. But anyway, so you get the idea, right? Something is raining from top, but you can measure. Imagine it's raining stones from the top or flowers. Let's say, the gods are pleased with you, and they're just raining flowers, and those flowers are falling down on a square and a circle adjacent to each other. At the end of the day, you decide to count the number of flowers versus the number of flowers in square versus number of flowers in the circle. So now the ratio of that, it happens to be pi. Okay, pi 22/7. Are you with me?
Yes, sir.
Yeah. So it's just the ratio. Okay. Now similar thing happens. Let's say you're throwing dice, right? You're throwing a dice, and that dice you want to calculate. You want to see how many times you get a six. Dice has got like 1, 2, 3, 4, 5, 6, right? So you got the first six. First time you threw, you're lucky. You got the first six. Then the second time also you got a six. You thought that you are a martingale. What is a martingale? Last the gambler thinks that the last bet is as good as this one. You got a six again. You got a six again. You got a six again. Oh, in six throws you got continuous sixes. So if you just take these observations, you will think that the chance of getting a six is what? 100%, isn't it? Because you got six times, and the number of observations is six. So what is the chance that you got? So somebody comes along and asks you, the next throw, will I get a six? What will your answer be?
Sir, if I'm only referring the data which I have, I'll still I'll just say it's gonna be 1.
Yeah, correct. But what should your answer be really?
1/6, sir.
Correct. So now what you do is, this is what I'm trying to say, what Monte Carlo is. The hailstorm example was difficult. But now suppose there were a machine which throws 100,000 times, just keeps on throwing the dice and observes if it's six or not, observe six or not, observe six or not. Now, if you do it 100,000 times, what Monte Carlo says is that because you're doing it so many times, the answer will match exactly 1/6 or very near to 1/6. You got it? Did you get it?
Yes, I got it.
Yeah. So that is the essence of Monte Carlo. Now, how does it matter in option pricing? Suppose your interest rate was zero, strike price is 22, and suppose now from tomorrow your stock price is 20, 21, 22, 23, 24. And suppose this is a probability 1/16, 4/16, 6/16, 4/16, 1/16. Now you can actually calculate the probability that of making money, right? The expected value of the option. If you were to have the E of the expected value of the option, what is that going to be? It is nothing but so here the option is in money, 23, it is in money. So 23 minus 22 into the probability 4/16. 24 minus 22 into the probability that it is 1/16. And then you get the net probability as 3/8. Correct? So now you are saying the expected value of this option is 3/8. Okay. Suppose you don't want to use the Black-Scholes formula. You want to say that, I want to use Monte Carlo. You could just generate these prices artificially into a machine, and you could generate 100,000 prices, whatever number. And then you can assign probabilities to each of them, and then you can calculate the expected value of the thing, right? You can, somebody mentioned binomial pricing model. The binomial pricing model is exactly like this, right? You take this, it has got a 50% chance of going up, 50% chance of going down. Again from here, 50% chance of going up, 50% chance of going down, 50% chance of going up, 50% chances of going down, so on and so forth, right? 50%, 50%. And you keep on doing it, let's say 100,000 times, 1 lakh times. You don't have to bother, computer is doing it, and then just calculate the probability. Then you get the expected value of the option. That's what it is. So Monte Carlo will allow you these simulations, and you in fact saw one of those simulations. Where did you see this? Tell me. We saw this on day
Sir,
one.
was
We
it the
saw.
random walk?
Yes. So this is what happened in the more than the random walk. I'm just going there. More than the random walk, Cherry had the most questions on that section. Cherry, do you remember your questions? What did we do with that Python piece of Python code you've got, which is generating this? All I did was I got 1 year stock, 1 year price for TCS for the past 1 year. I calculated the mean return. I calculated the expected return. Sorry, the standard deviation. And then what did I do? Can somebody tell me what did we do?
So we assigned it a couple of steps, 1 and -1, and this way we simulated it, I think around 100 times or 1,000 times or something. Not sure.
Yeah, correct. But what happened in each step? How did we calculate? So this thing, how many steps you can see here? You can see on the
250, sir?
around 252 or 260. To be 260 was the exact. I think it's 260.
Yeah.
So for each step, we had a value. And how did we calculate the stock price at that value?
Sir, it was basically a 50-50 chance for it to either go up by 1 or go down by 1.
No, that was for the first random walk thing, not for the second one.
Acha, oh.
What did we do?
Could you please ask again? What are you?
So what did we do in each of the step? Like how did we get the stock price at, let's say,
So
step 1, step
we
2?
basically set a condition
Sorry?
that either, so first randomly it will be generating a series of either plus ones or minus ones,
Yeah.
and these accumulate over time to make us reach the different parts of different graphs. So now we don't run the experiment only once, we run this experiment multiple times and we get the different graphs.
No, I think you are still conflating that with the first random walk thing. Cherry, you asked me the question there.
Yes.
Can you tell me? I hope you are still around.
Sir,
Cherry?
it had something to do with the drift. I'm not sure what exactly it was.
Yeah, exactly. Cherry, are you there? Probably she has left. So the thing that we did was, we saw that, we said that, we are using log normal distribution. And then if you recollect, the Python code had this S, the stock price S is equal to S0 raised to into E raised to this big thing, right? Which contained the drift and the diffusion, right? The drift plus the diffusion. And there was a formula for that. And that formula contained one random variable. What was that random variable? Anybody?
ZT, sir.
Sorry? Yes, that's right. Yes. So ZT was mm, ZT was a random variable. It is just, if you recollect, it was just a normal distribution with mean 0 and variance of how much? Variance of how much?
So maybe
Mean
one
yeah,
or
not maybe one, always one.
always
We
one.
are talking about Z values, right?
Yes,
Need
sir.
to need to brush up your probability concepts and normal distribution curve concepts. So that was the random variable, and that was completely random. Well, actually, the random generation that happens in Python code and C code is not really random. Random events are extremely difficult to produce artificially. You know that, right? Do you know that?
Yes, sir.
So the lightning is a random event, but in a machine, you can give a seed and then you can get you think it is a random event, but you know, whatever I do in my code will exactly happen with Cherry's code also, Ali's code also, and so on. If you start at the same time, suppose people use time as a random number generator, you know, you can do that. So cryptographers actually make a living by giving good random number generations. But yeah, so that is the thing about Monte Carlo, and I didn't want to go into the deep maths of this. So there is maths. I mean, what it is trying to do is, no matter what calculus you're using, you're dealing with probability, and you're using a computer. So Monte Carlo becomes the method of choice to find out hundreds and thousands of simulations and come up with the answer, and that answer is likely to be closer to what the actual answer is. That's all there is to it. Okay, so I'll stop over here. Any questions so far? We've got a few minutes left. Maybe I can just show you the code. Like, yeah, I think Professor Panda asked me to show visualizations, but I think visualizations are. I'll show you. I mean, you've seen some of the visualizations, right? So this something has happened. Sorry. Just one second. You've seen the visualizations, all of the plots, not a single plot that I used in the course has been generated by Excel. It is all done in Python. It's beautiful. Your life will change for the better, if you embrace Python, because yeah, you'll and there's no competition here, because as you go into your journey, as you become specialists in your field, if you embrace Python and become good at it, and not as coders, but at least you should be able to generate hacks at will. You don't have to be syntactically right. You can just go google things, and then you'll find half your answers. I'm just showing you some of the cool visualizations in Python. Give 1 second. You're able to see my screen, right? Hello?
Yes, sir.
Yes, sir.
Just give me, it's I've actually got a deck prepared for visualizations also. I mean, the simplest visualizations for you to to start life, as a Python programmer. So now this is for partial derivatives. See this? I generated, you all saw that graph, right? I generated this graph using this. Everything is done in Python. This is where I defined the function, the partial derivative, and I said the partial derivative is 2x. In fact, there is one more function which now I've kind of hard coded 2x here. There's one more function which can actually calculate it. I didn't want to use it to make it too complicated, but using symbols, what happens in Python, you can actually calculate equations, a variable over a variable. So this function f of xy, it does this. This was the function x square plus y square, and then I created a imaginary array, not imaginary, real array. Line space functions gives me, you know, from -5 to 5, from -5 to 5, it gives me 1,000 numbers. It divides that interval in 1,000 numbers. This also creates 1,000 numbers. So now I've got my x-axis, and then I get my y-axis. Sorry, just 1 second. I can't do the pointer here. And then from this I create a mesh grid, the small grid, And here is where I calculate the z value, right? The z value, I calculate the z value as x square plus y square. Sorry. The yeah, PDF. What is PDF? Yeah, calculate the x square plus y square. So for each of these values in the array, I calculate the z value. Now I just start to plot it. I plot everything, and then I plot two surfaces. The first surface is the actual z value. Remember this, f of xy, and the second surface is the partial derivative. So I plot that, and then that's it. I get this. You do you think that the colors are amazing? And this is what I did with this is the program I shared with you. This was Apple prize. I gave you a TCS prize. And no, sorry, I gave TCS. This is also TCS prize. And this is what this is for the option payoff program. This I didn't show to you, but what is the stock and the stock price and the put price. Stock price goes up, this goes out of money, and stock price goes down, it goes in the money. Then this is the other equation that I showed to you. This is the integral equation that I showed to you, so on and so forth. So there's a really cool visualizations that are possible in Python. I'll share some of the code with you, but that's where we are at. Any questions?
So would you be sharing these presentations, whatever you've used over the past 3 days with us?
Yeah, sure. I can do that. Yes.
Sure. Thank you so much, sir.
Okay. Who's this?
Ali, sir.
Yeah. Anything else?
Sir, and there was just one book which you mentioned for Taleb, right? For
Yeah,
the maths behind the derivatives. What was its name again?
I forgot the name, but it's actually Dynamic Hedging by Taleb or something like that. You can it's freely available. He has made it. The maths is pretty deep. So, yeah, you can use that. But the book that I showed to you yesterday, I don't have it here, unfortunately. Maybe I have it in my bag. Buy that. It's a cheaper book. Maybe by
What's
now,
its name,
there
sir?
must be a free version. No, it's forget about cheaper. It's a easier to understand book.
Yeah. So what's the name of the book then?
1 second, let me get it to you. 1 second.
France the Worth,
Yeah, Frank's the
France,
word.
an introduction to options trading.
Yeah, 1 second. So it's France D word. I'll put it on the chat. 1 second. Or let me see if I can. Maybe if you're lucky, there's a free copy somewhere. France D word introduction to options trading. No, there's no free copy, but actually there is. But buy it. I mean, if suppose you want to actually do this, I would actually buy it. I mean, if you are going to do it for a living, out of respect to the author, try to buy the book. I'm putting it on the chat. 1 second. So I think this is from the my friend Prashant Nunaha, who's from Australia. He's still probably he's an expert options trader. Uh, he kind of like urged me to read this book. As I mentioned to you, this was way back in 2006, 7, 8. I still have that copy with me, and I had to brush it up and dust it off to for this course. But anyway, that's it. Thank you very much. I guess you got another meeting coming up, right? Another thing coming up.
Class, yes.
Yes, sir.
Yeah, all the best to you. I hope you have enjoyed the 3 days. I did.
Yes, sir. Thank you so much.
Bye bye then. See you.
Thank you so much, sir.
Is this the last class, sir, with you?
I was told, see, I committed. I mean, this is a huge commitment for me. So, I said I'll do 3 classes, and they have not come up for with more. Uh, I guess one of the things that this Professor Panda wanted to cover was visualizations. And if you're interested in visualizations, maybe we can do one more class. But let me know, and we can do it. Okay.
Sir, if I had to ask you that over the 3 days, what would be the biggest takeaway we should be taking away from these 3 classes? What would you say?
Uh, so the biggest takeaway is actually delta hedging. Okay, so delta hedging is at the core of. Uh, I mean, I can't say that this is the biggest takeaway, but as an options trader, because this class was about Greeks, it was. I mean, there were three specific things I was asked to cover. Those were partial differential equations, uh, uh, Greeks, uh, Monte Carlo, and and this one, the what is that, visualizations. So it was clear to me that I couldn't do visualization. I mean, it was too much. So these were three different and distinct topics, right? So in that sense, like the first topic, which is which is partial derivatives. You know what the biggest takeaway there is? You tell me, Neil, what was the biggest takeaway there?
So with partial derivatives?
Yeah, on that topic, right? I mean, partial derivatives is just maths, but
Yes,
we saw. I mean, the entire equation, Black-Scholes, is actually a partial derivative.
yes, and also the other thing we were talking about is some things are stochastic and some things are non-stochastic. So how we have to deal with them is different.
Correct. So that was the biggest takeaway there, right? I mean, uh, if you wanted to go deep into maths, you'll have to give up something in life. I think to get something, you'll have to give up something because time is limited. It's possible. So if you want to actually become an options trader, I would encourage you actively to go into the maths. But if you want to, if your interest is something else and you want to slowly develop it, do it. I mean, read books from Follow Taleb on Twitter. I mean, I can't understand half the things he's saying. It is deep maths, and he's doing it for a living. Okay, so not half the things, but many things he says. The second area was about Greeks. Now, the crown of everything in Greeks is delta hedging. It's a crown piece, right? Crown. But we saw in that second piece, what did we see, Neil? Like you saw that. What was your takeaway?
So my main takeaway is that our maths does not sit very comfortably and linearly in these cases, and we have to constantly take into account time as a factor and volatility as a factor when we make these decisions.
Correct, but we also saw that you could intuitively think of things, right? So
Yes,
you
sir.
could intuitively think of what is volatility. You could intuitively think as, what if I were to own that option?
Yes, sir.
So delta hedging was a crown mantle of Greeks, right? Because that's what people do for a living. And you saw that in delta hedging, if you do it enough times, I mean, we have not proven it, but about 70, 80, 90% of the time, delta hedgers make profit. Of course, you've got outliers like LTCM, and people can blow up, right? So that was the second piece. The third piece, where we didn't spend much of time, like we just looked at Monte Carlo. We touched upon it in different ways. It is a smaller piece, but the biggest takeaway there was that if you use computers and if you simulate hundreds and thousands of times pathways, you may actually get the right answer. Any other interesting takeaways for anybody else from this? Anyone? I want to understand who from this class is now going to buy an option.
So probably not me for the next 6 to 7 months.
Anybody who's going to buy?
Sir, I just had a question regarding trading. Sir,
Yes.
in many large financial institutions, is trading generally algorithm based?
Yeah, so that's a good question. So there are two types, right? So trading now, most of the trading that happens, as you know, in the what you call as algo trading. Algo trading is completely different. So almost 20% of the stock market uh, in India has got algos in it. So one algo talking to the other, okay, and the percentage may be actually higher in derivatives. Now, what these algo trades do is they're completely insensitive. They're not talking fundamentals. They try to, I mean, basically in life, in investing, whether you're a machine or a human being, your point in life is to identify mispricing, buy low, sell high. That's it. No matter what asset class you're taking, whether it's options, whether it's futures, whether it's stocks, or whether it's bonds. And by the way, there are options on bonds also. Okay. So, and there are options on swaps also. You may have covered swaps, right? They're called as swaptions. So that goes into the exotics piece. But anyway, coming back to your question, Prasoon. So 20% of whether you like it or not is done by algos. You should read this book. The most successful hedge fund. You should read this book called "The Man Who Knew Everything." Read that book. You'll see that how machines, and you'll see the huge pressure computers, human beings take in order to program what they are doing. Okay, so that's algo trading. Now, when it comes to a trading desk on a investment bank such as Citigroup, what happens is it has got 2 3 sections. There are specialist traders who are prop traders. So what they do is prop trading, meaning they identify, like they work with people like me, and we identify opportunities, mispricings, and that mispricing, it's proprietary money, and they place that money. It's very difficult to be a trader, I'll tell you. It's very, very difficult. But options trader is actually being easy. Okay, it's slightly easier because there's a lot of maths in it and the competition is less. The next piece is program trading. Program trading is looking at big events and then saying that, suppose there's a stock is going to get into the index. Stock is going to get into the index. Then there's a huge amount of inflow and outflow. Inflow, stock is going to get out of the index, huge amount of outflow. So that's what program trading is all about. There are programs. Suppose you're a big buyer, you want to buy 100 crores worth of TCS stock. You have to do it in stealth, right? If you announce that you're going to go to the market and buy 100 crores of stock, that's it, you're dead, because people will front run you. So that's program trading. Now, in program trading, a lot of computers are used. Okay, so they operate in a stealth mode. In fact, what happens is, uh, there are specialized computer programs and algorithms called icebergs and whatever, very fancy names. Suppose you want to buy 100 crores, what they'll do is they'll go well below the water. They'll hide and mask their trades. They'll they will trade. They'll buy TCS or almost over 2 weeks, 3 weeks. Biting a little bit here and there, till they are done with the trade. So, long answer to your question, Prasoon. There is the stats say that algo trading is 20%. Internet-based trading is, their machines, Zerodha, is almost 20 30%, and the rest of it is actually by humans. In the US, there are black pools. they are those pools are banned in India. And what happens in pools is that there is an automatic matching of orders. So that's it's a fascinating area, but that's not our subject matter today, right? Or in the last 3 days.
Yes, sir. Thanks.
Okay, we're good. Okay then.
Yes, sir.
See you. Cheers. Bye. Thank you.
Thank you, sir.
Thank you, sir.